All right. Hi there, and welcome to Riding the Wheel, the option pit method. So here's what you're going to learn. You're going to learn the structure of a covered call, the structure of a cash secured put, how time premium decays, the perfect covered call, the perfect cash secured put, 5 secrets to great covered calls and cash secured puts, trading income wheel, including my index wheel, and I'm also going to talk about hedging at the end. So it should be a really interesting little piece. All right, so let's just hit out some basics here. What is a covered call? A covered call is a combination of long stock position and a short call. The combination creates positions that can produce positive cash flow, increase an investor's margin for error, help the investor make sell decisions, one of the problems a lot of investors have. So let's talk about making a covered call. We'll start with 100 shares of Facebook. So here's Facebook trading 139.75. And as you can see, that delta, which represents our slope relative to the underlying, for every dollar the underlying makes, I make about $100. For every dollar the underlying drops, I lose about $100. So that is my delta. All right, then we have a covered call. All right, so we have the selling the call piece. So when I sell a call, I get to collect the time premium. In this case, I sell a Facebook 140 call at $2.20. And what you'll notice is that as time passes, the amount of money I make increases. If the underlying drops a lot, though, it does not. It just kind of all comes to me. At the end of rallies, it turns into a problem. Combined, so by owning the stock and selling the call at 220, the combination creates a graph that looks like this. So notice the break even is now below 137.55. So I picked up a $2.20 lower break even. All right, not bad. So the net of the trade, all right, is we collected a premium on the trade, which lowers our cost basis on our stock. We limited our upside because if the stock moves above our call strike price, our stock will be called away. Break even is now 137.55, but the most we can make on the stock, on my Facebook stock, at expiration is 142.20. All right. Now it's a lot more complex than that, but that's kind of the basics of the setup. All right, kind of the basics of the setup. So here's the lowdown. All right. What is the yield of the trade on takeout? All right. Well, stock price is 139.75. My strike price is 140, and my option price is 220. Simple total return for the time period is 140 is the stock price plus the option price minus the stock price. All right. So strike plus option price minus stock price over stock price. So it's $1.40 plus 220 minus 139.75 over 139.75. So my total return is $2.45 for this period, or about 1 3/4%. All right, generally, I'm trying to make at least 1% per month on my just the income from covered calls. Here's a brief old example of how a covered call might work. All right, you have Apple stock. All right. It started out trading $450.50 and ended trading $452. All right. So just the stock, I make $1.50 over this 2-month period. Right now, if I did covered calls against it in February, I might have sold the $450 call at 13.5. I buy it back for $10.25. I make $3.25. In Feb, I sell a March call this should be 124. So on February 15th, I sell a March 460 call, collect 1360, exit price, I pay 2 cents for it, make 13.58. And then finally, in March, I sell an April call at 14.75. I have to buy it back for 17.80. So I actually lost money. But net, over this 4-month period, or really a 3-month period, I made $15.28 on my stock, or on my covered call strategy. I only made $1.50 on the stock. So I could make $1 of 1.33%, or I could make 13.57% annualized. Which would you rather have? Pretty simple, right? Pretty simple. All right, so now, most of you probably know what a covered call is. So let's talk about some management practices for covered calls. If you do not get the stock called away, buy the call back and sell another expiration. All right. Now, this is one of the issues I do run into people is they don't understand how time premium really decays. All right. If you can buy the call back for less than 9 cents, all right, buy it back and sell another expiration. All right. Believe it or not, you'll actually make more money buying back calls that cost less than 9 cents than you will holding them out to expiration and selling next strike. All right. So let me kind of show you what I mean by that. If you look at how calls or how options really decay, most people think that it's like this, right? Right. This is what most people are educated about, right? Well, it's relatively accurate. All right. All right. But really, there's kind of a secondary piece where if you do it like this, you kind of end up doing this, where something that looks kind of like this. So when it gets to be cheap enough, decay slows down again. All right. And then that final, nickel might not come out until, the day of expiration. I mean, let me pull up a chart of live vol. Let's just look at SPY options that expire tomorrow. All right. Tomorrow is Wednesday. There's I believe, a SPY expiration. This may take a little bit. Or here, VIX definitely expires tomorrow. All right, so these are VIX weeklies that expire tomorrow. It's trading 15. These literally expire on the open tomorrow. And there's a bid for options that are well out of the money. And that's one of the things to be aware of, is that options that are kind of well out of the money, get these loaded. It's like looking at Facebook. All right, this expires on Friday, or excuse me, on Thursday. So in 2 days, Facebook's trading 139. There's a bid for the 145 calls. I can't even buy the 146 calls for a penny. And look, I mean, this is really what I mean. There's a 3-cent bid on the 143s, a 2-cent bid on the 144s, and a 1-cent bid on the 145s. These are retaining a lot of value that will stay there until basically Wednesday. Meanwhile, if I go to, let's say, regular May, all right, these meaty options that are up in here, the 150s, the 145s, look at how much theta they have. All right, this is losing 5 cents a day. All right, my April 13 at 145 actually have a smaller theta. Look at that, they're losing a penny a day. So you're actually, by not closing those trades, you are leaving money on the table. All right. So now what if the stock does get called away? The answer is let it get called away. A lot of people like have this weird thing where they don't, they like are in love with these stocks, and when they sell covered calls, they go and buy them back. Well, it kind of defeats the purpose. You know, the reason why you sell a covered call is because it's a level that you think that the premium that you collect and the other pieces are worth it. So if the stock runs through the call, let the stock get called away. Take a day or two, then decide to enter a new trade. All right, so now let's talk next. All right, what does this look like? Looks a lot like a covered call, right? All right, but it is in fact a short put. All right, they're literally, this is the covered call, this is the short put. They literally look almost exactly the same, just a slightly different underlying price, about 10 cents away. They're legitimately, and so one thing to remember is there are these crazy firms that will let traders do covered calls, but they won't let traders do cash secured puts, even though they have almost the exact same risk profile. It's kind of silliness. So a cash secured put has almost all of the same risk characteristics as a covered call. Now, the main difference just comes from assignment, but even that's not that big. All right. Generally speaking, a covered call will only get called away where there is a dividend. All right. And that option is in the money. All right. Seller has the stock taken away. Cash secured put will get put to the trader. Generally speaking, an option is in the money at expiration. An option becomes extremely in the money prior to expiration. This is related to carrying costs, all right? And instead of having the stock taken away, in this case, they actually get the stock. So that's really the main difference between a covered call and a cash secured put. You know, just a little bit on around the edges and assignment, but that's it. Not a lot. All right. So now, the trader is hoping to sell put after put without being assigned, thus building large amounts of yield before taking delivery. In the Facebook puts, I'm selling an option with 17 days to expire, collecting $2.20. If I'm never put to and can collect $2.20 every 17 days for a year, I'd make about $47. All right, that's almost 34% based on that strike price of 140. That's not bad. All right, so the management mechanics. Right, the main difference in mechanics is that cash secured puts should typically be sold for slightly out of the money instead of near the money. If the put can be back for 9 cents or a nickel, buy it back. If the stock gets put to you, you have to be willing to accept assignment. Absolutely have to be willing. All right, duration. At 30 days to expiration, at-the-money options see a dramatic increase in time decay. Early sales decay slowly. In the final week, that call or put sale still has a huge portion of decay to lose. So new traders need to think hard about the duration of the call or put they sell. As they become better traders, they may want to adjust the duration. All right. So again, there is that steepness. If you sell a lot of weeklies, there can be an advantage. How much margin would this require? It's the same as buying a stock. Right. So, and someone said the advantage of the covered call is you get the dividends if the stock is not called away when compared to a cash secured put. Well, actually, the dividend part of the synthetic formula. The dividend is priced into the call and the put. All right. Now, in this case, Facebook doesn't have a dividend. But believe it or not, from an option trader's perspective, the dividend portion is priced in. But we'll talk about dividends. Right. But what I want you to notice is that, yeah, you do start making a lot of money at 30 days, but at 8 days, man, whew, that thing loses a ton of dough. All right, weekly versus monthly. All right, I just want to show you how the difference is. All right, between August and September expiration of 2014, there are 4 weekly Facebook contracts. Facebook was trading a little over $73. All right, would I rather sold the Aug-Sep weekly 74 calls 4 times or the Sep 5 calls? So I'd rather sell 4 weeks of the 74 calls or the just kind of 1 month out call. Let's take a look. So February 6th, if you look at here, here's all these different days. This is a little updated, 76. So when you look, it's February 6th. If I sell the 76 calls, so at the money, I get $1.10 4 times. That would be $4.40. That's not bad. If I do the regular Feb 27s that have a month to go, I would only get about $2.35. Well, clearly, I make more money if I do the weeklies. But the monthlies aren't bad. So why? Well, it has to do with skill. You need to know how good your skills are. If you're an expert, using weeklies may make sense. If you are new, a monthly approach might make more sense for you as a trader. All right. Know who you are. Don't be a hero, especially at first. Big mistake a lot of people make. All right. So the big reason why you collect more is that, by selling these 4 weeklies, you're taking some reinvestment risk. What if Facebook drops? What if Facebook rallies? What if volatility comes in? Those prices can change, whereas the monthly does not have the same amount of reinvestment risk. All right, so now here's a perfect covered call. So a perfect covered call has an underlying that would creep higher every month, but would not skyrocket. The trader would be able to sell calls consistently at a higher and higher strike price, building yield. The trader is never called away except for at the absolute top, and the stock pays a dividend, further increasing yield. Perfect covered call. Right now, the perfect cash secured put, the underlying would creep lower every month but would not tank. The trader would be able to sell consistently puts at lower and lower prices, again, building yield, and the stock isn't put to the trader until the very bottom. That's the perfect scenario. Now, do you think that happens a lot? All right, here's a question. Does a bull credit spread put still lose time decay, or is it just the bear call spread? Nope. Bull and bear credit spreads lose the same. How does a weekly premium with 7 to 8 days compare with 3 or 4 days left? Well, again, that's a great question. It is exponential. So there can be some value even there. Now, at a certain point, if there's, at 3 or 4 days, there may not be enough premium to be worth selling. Now, at a certain point, Do you want to sell a option that has 3 days to expire at 10 cents? Or would you rather get a quarter for something with 8 days? Even though it's, technically you're making more money, is it really worth it then? All right. How to sell puts and calls. All right. There are some smart things that can be done to manage the sale of puts and calls. Many involve the volatility of the stock and simple decision making from the trader. All right. So let's talk about how to actually find stuff. All right. What type of stock creeps higher, an Amazon or a Microsoft? Yeah, Microsoft is not a high flyer. A little bit lately, but not really. Meanwhile, Amazon is a crazy person stock. All right. A trader that sells puts or covered calls on a high volatility stock like Amazon is going to, multiple times over a year, be presented with, do I cover this because I'm about to get put or I'm about to get my stock called away? It's going to be part of the equation. Right now. So you want to go for lower volatility stocks. All right. Stocks that pay dividends typically will have lower volatility. They'll also have a nice dividend yield that, combined with the yield from selling covered calls, can produce a nice income stream. Now, there's a difference between being the option, having that priced into the stock, and the actual income coming in. You may rather, if you're a senior or in retirement, you may rather have the income stream coming straight in rather than having it be kind of priced as a part of a put option. Dividends can also soften the blow of being put to in a cash secured put. All right. And the dividend will typically creep higher with increases in the dividend. All right, now, the strike. I like to sell a covered call at a strike that would produce a net price that I would sell the stock at today. So if I buy GE for 2015 and I sell a 21 call at 15 cents, with 30 days to expiration, that would be a 4.9% takeout yield. All right, so I'd make almost 5% if I get called away. Am I happy with that return? All right, well, one thing, most of that return comes from the stock and not the option. And do I collect the dividend? So this might be one I don't want to do. All right, sell a call at a level you do not mind having the stock call away. Surprisingly, you'll find this is kind of either at the money or, it can be as high as 30 delta typically. I like selling 30 delta calls. All right. Here's a comment. If you forget to close a trade, but it has value on expiration day, what happens to the amount of money you earned? Well, if it has, that will come in. All right. If it still has value at expiration, that final piece of value will come in, assuming you don't lose the stock. All right. Does weekend premium still exist, or do market makers bid it out of existence? It does, Bruce. It does. There is some weekend premium. All right. It's not a lot, but there is some weekend premium. All right. So now the strike. I like to sell a cash secured put that I would like to own the stock for. So if I sell my Facebook 140 put at $2.30 GE, I am buying Facebook for about a 1.6% discount. Do I want to do that? Maybe, maybe not. Do I want to? Is 1.6% off enough for me to take the stock? Maybe, maybe not. I think it depends on what the stock has done. Again, you might find this is the at the money put. So if I were going to kind of look at Facebook stock, it's had a nice run, but it's been a lot softer. All right. kind of back to March levels after being way high. So, you know, when a stock's been really soft, maybe that 1.6% discount is good. Maybe it's not. Maybe it's near high and you don't want to take delivery. All right, so really the previous 4 slides are really to prove one point. It's not the premium that matters, although, you know, of course you want some premium. It's the overall volatility of the stock. It's how much it's moving. Trade covered calls in cash secured puts in low volatility, low beta stocks, and you will be a happy person. All right, so now let's talk about the 5 secrets. All right, now, have any of you actually ever been to a webinar where they tell you that they've got some secret thing? I have my secret proprietary system. You know, I'm sharing it with you. All right, well, here's a question for you. If that proprietary system, all right, so I run a hedge fund, right? Now, do you see me yammering about what my hedge fund strategy is? No, all right. Why? Well, it works, and I owe it to my investors to try and make them money, all right? Now, I can teach you all sorts of things that are valuable about how I trade, how I think, but I can't just sit there and tell you what I do, right? That doesn't help anybody. Hurts me, hurts you. So anybody who says there's a secret is a liar. There's no secrets. Puts I usually sell closer. So the question was, so puts are sold for around a 30 delta loss. Puts I usually sell kind of the first strike out of the money. So there are no secrets, but there are the right ways to do things. So really, these 5 secrets are really the 5 right ways to trade a cash secured put and covered call. All right. Secret 1, only trade in stocks that you are confident won't go down. All right. Notice I didn't say stocks that will go up. All right. There's a big difference between stocks that don't drop versus stocks that rally. Stocks that don't drop also don't move higher that quickly. All right. So, you know, if I think a stock's going to go up, what should I do? What should I do if I think a stock's going to go up? Buy a call. That's correct, Tim. Right. All right. That's entirely different than I think a stock's not going to go down. If I think something's not going to go down, I should sell a put or sell a call. If I think something's going to happen, I want to buy option. If I think something won't happen, that is when I sell options. Does that make sense? All right. So the big thing to remember is you'll want to trade stocks that won't go down. Secret 1. All right. Secret 2, find stocks that are lower volatility. Stocks that have lower volatility will pay a smaller premium, but will likely not fall below your break even. If it does, it will only do so by a small margin. That another sale can extend the break even. Typically, low vol stocks do have a little less premium, but they tend to be a lot more consistent. All right, now, if a low vol stock becomes a high vol stock, you think it makes sense to keep going with this strategy? It's like when IBM screwed the pooch, right? Did it make sense to keep doing a covered call or put sale strategy? No. All right, buy stocks with a nice dividend stream. Secret 3. All right. All right, yeah. And secret 4, only trade in stocks that you have knowledge of and want to own, even if it looks like a good candidate. All right. Like if you know nothing about healthcare, don't buy UNH or Cardinal or things like that. All right. And don't trade in cruddy, crappy stocks like Groupon. or poupon, as we used to call it. So trade stuff that you understand. All right, now finally, if the premium is too cheap, you have to be willing to say there is no option I want to sell right now. All right, think buy puts and stock instead. You could do a cash security. You could do a protected put strategy. And remember, it never makes sense to sell options at 10 cents or less. And in fact, you should almost always cover them when they're below 10 cents, at a minimum a nickel. All right, now, how do you all put this together? And this is where the triple income wheel comes into play. All right, and I think it's the best way to use call and put sales in tandem. All right, in the wheel, the trader is using three sources of income to produce income. Source one, puts. The first rotation of the wheel is to start selling puts. All right, follow the secrets in selling the put to sell and finding the put to sell. Keep selling that put over and over again, building up yield. All right. Sell puts at lower and lower strike prices. Then hopefully the stock gets put to you near the bottom. Source two, the dividend. If the stock is put to the trader is able to collect the dividend. Younger traders should execute a drip to acquire more shares of the stock. All right, it's great. Dividend reinvestment program. Older people and employees of the actual company. One, if you work for a company, should you own a lot of your, if you work for a company, how much of that company stock should you own? Unless you are like in the C-suite, as little as possible. Own what they give you. Don't buy more. All right. Why? Anybody know what? Yeah, it's called Texas hedging where we're from. Because Texans go big. So the idea was when you bought calls and hedged it by buying stock, you were going super big on long, so you were Texas hedging. So if you're older employee, just take the dividend, put it in the overall market. Now, finally, sell calls. Once a stock is put to the trader should begin selling covered calls. Calls should be sold at the strike the trader was put to or higher, typically a 30 delta. Recall that even if the trader buys and sells the same stock at the same strike price, he or she will collect all that triple income. So in Facebook, if I get put at 140 and then I get called away at 140, I'm happy. I made a bunch of money on my premium. All right, now, once a full rotation of the wheel happens, wait a day or two before selling puts again. Examine to see if there are better sales, if there are better trades, right? Just because you made money doesn't mean you did the right trade. Just because you made money doesn't mean you made the right trade, all right? If an assumption changes, stop. All right. IBM used to be a great candidate, but is it now? No, they're having problems. Hewlett Packard used to be a great candidate. They're having problems. All right. All right. Now, you should have at least 1%. The question is, what's the target percentage? At least 1% if you can get it. All right. Like a long position, if the trader owns, for like a 1 month trade, it should be more than 1%. All right. Weeklies are a little different. Like a long stock position, if the trader owns the stock, he or she still needs to have a max loss on the long position. You have to be willing to say, this was a mistake. Here's a little example of Oracle I did for TheStreet.com, where I write every now and again. So in September, I sell a 39 put. I collect 22 cents. Take delivery. On September 29th, all right, I sell the OC3 1039 call at 13. On October 6th, I sell the October 1039.5 call at 13. I collected a 12-cent dividend that week. On October 13th, I sell the October 1839 calls at a quarter. On October 20, I sell the October 39 calls at 24. I get called away. All right, so I did 5 weeks of trading here. I collected $1.09 over those 5 weeks. So my yield was 109 over 39, or about 2.7%. Annualized, it was about 30%. That is how one execute a wheel. All right, now, let's talk about how to do this with indexes. Put BXY, all right? This concept of the wheel can be applied to BXY and the put right index, all right? The trader can swap back and forth between put and BXY as a way to try and buy the SPX in weakness and sell in strength. Basically, the trader takes delivery in put, the trader might switch to BXY. When the trader is called away from BXY, he or she would move back to put right, just like the wheel. So here's what put right does. It's an SPX out of the money put. Here's BXY, all right? It's selling. BXY does 2% out of the money. One can also do like a 30 delta call. But BXY is simple and has a nice long track record. So when I apply data from put and BXY using my in and out system, and I compared it to the SPX total return, and this was through the end of 2015. And it worked in 2016 as well. You know, I then traded, so when SPX total return went negative on the month, so I trade put right index, month in and right, month out. I can do it in SPY as well. All right. And then when, until the SPX total return went negative on the month. When SPX total return goes negative on the month, I switch to BXY. I trade BXY month in and month out until the SPX total return rallies more than 2% in a given month. And once the SPX total return rallies beyond 2%, the strategy moves back into put right. And so you're basically long the broad market. But through kind of 2015, my return was about 10.5% with a standard deviation of 12 versus the total return was about 7.3 with a standard deviation of 16.4. So I get over 300 basis points, and I get 75% of the volatility. What is BXY? BXY is long. BXY is long the S&P 500, short a 30-day call, 2% out of the money. Put is short the first put just out of the money at 30 days to expiration. I own Apple. Is Apple a candidate for a wheel? It's an interesting one, James. It does move, but it's not a bad candidate for a wheel. All right, so now let's talk about some things that I do. All right, on its own, this system crushes the S&P 500. All right, I'm in the middle of testing. I am doing this, a long short indicator that has not been overlaid with the system before. All right, but one thing that we do when VIX is more than 1 point over VXV for 5 days, cover the short put, get back in when it recrosses 0 for more than 3 days. It'll avoid catastrophic losses and will cause some underperformance on upside, but the net's a pretty big win. All right, now the other thing to think about is the concept of crisis alpha. And I like this better. Rather, there's a lot of people, hedging all the time is expensive. So the alternative to going to cash or being hedged all the time is to use this concept of crisis alpha. All right, and it's an approach that attempts to go long volatility at specific times. The index I can look at is the KZT vol index, KZT vol. All right, and what it does is it goes long what amounts to VXX under when the VIX futures get somewhat backward. So right now, KZT just got long. All right, and when KZT vol says buy, in that its dollar figure starts to move, buy VXX against a portfolio of stocks using 25 to 50% of your stock margin. All right. KZT vol, just being clear, Mike and Matt Thompson, who created it, are my very, very good friends. And they run a little overlay strategy. And here's what it looks like with my S&P and kind of going long VXX. It's a lot smoother. So in summary, high flyers aren't for premium selling calls. Turtle stocks are perfect for covered calls. Learn the secrets and trade the wheel. All right, so speaking of which, I have a new product called the Weekly Wheel. All right, and I am going to sell up to about, somewhere between 5 and 10 cash secured puts. The goal being to get long, to collect put premium, and then potentially get have the stock put to us and start selling covered calls. So right now the portfolio has been around for a little over about a month, 5 weeks to be exact. And it's got a little exposure to tech, a little exposure to banking, and a little exposure to energy. Selling weekly puts, and now that we have taken delivery on 3 stocks, we are now selling covered calls. We took delivery last week. And it's been a pretty nice, we've had a pretty nice performance, and I think it's going to do extremely well. And I'm going to let you guys try it for $7 for the first month. All right. So the downside risk is that if the market entirely tanks, you end up long some stocks. All right. But for $7, you get to try it for a month, and then it's $47 after that. All right. We try to pick stocks that we think won't go down. Right? They do sometimes a little bit. JP Morgan went down a touch. Facebook went down a little bit. And Intel went down a little bit. But I still like all of those trades as potential cash secured, and long term, I expect them all to be relatively profitable. So you go to https://optionpit.com.leadpages.co/dir replay. All right, I put the link in the chat, and I put the link in the where one can see questions. It will also you'll also have this offer in the replay where I'll actually have the replay of tonight's video. So with that, do I have any other questions? All right. Will the recommended stocks be expensive? Some will and some will not. How do you calculate that your put BXY and put positions volatility was only 75% of the overall market? By running standard deviation. So you could just run a daily standard deviation. You might mention the strategy works well in IRAs. It works great in IRAs. Thanks, Frank. What kind of return are you shooting for? I want to do, does the 47% include the live? No, but we will do some live education, and we will stream out some educational content. And we're going to do some webinars. We will do some webinars for around this. Do I avoid quarterly reporting? Generally speaking, yes, but not always. is this income trade or a long-term investment? It's great for an IRA, but we would think about it as a long-term investment. Should puts calls be sold around earnings? Generally, for a novice, no. I don't like trading into earnings very much. But I don't. But like I said, I don't always avoid it. And remember, these are just trades that I am doing. So I actually do put these on in our as a live trade. This is not just a fake portfolio. Is there a minimum threshold of capital? No, there's not. All right. What's the range of yearly return and the max drawdown? Well, we've only been at it for about five weeks, so that's a tough question to answer. I will have that answer in about a year, but based on what we're doing, I think that it will be lower than that of the S&P. Do you roll up, down, or just let it go? I will cover stuff when it gets too cheap. What is the return I'm shooting for? I'm trying to get on a weekly trade at least 0.5% on the stock, preferably. All right, and yeah, I will roll. I have a registered account in Canada that doesn't allow selling puts, even if it's cash covered, but does allow selling covered calls. Can the strategy work replacing puts? Potentially. Where can I sign up? Right here. I will send you the link. And there, he's got the link in his. Bruce, that may work. I think you're gonna have to think about like, a couple of small things with puts, but I don't. By the way, how silly is that? But yeah, I think there's a way to make that work. How do you like SLV for covered calls? I think silver is a better investment than gold. Yeah, I'm trying to get dividends. What's your favorite options, strategy and options? I don't have a favorite. Having a favorite strategy is what gets people into trouble. I take what the market gives me. Well, silver has industrial use and GLD has zero use. Why is it good for an IRA? Well, because if one's doing weekly wheels, there's going to be a lot of income produced, and you're going to be, taking profits on a weekly basis. And so the avoiding tax is a nice piece for an approach like this. You don't want short-term gains, except for an IRA, it's fine. Would you use this strategy in stocks that are getting crushed like Lulu and you? No, I would not, because Lulu is garbage, and I think Under Armour has all sorts of problems too. Here's the problem with Lulu and Under Armour. I think they're going to go down. But you could use the strategy of put selling if you wanted to get in a stock that had been beaten down that you thought was going to go higher. One trade a week, typically. All right. There may be, but we will roll the stocks that we do. So, for instance, we've done 3 or 4 trades in JP Morgan. We've done 3 or 4 trades in Intel. But we'll only do up to one new stock a week, and we may not even do a new stock every week. So like I said, you can get yourself signed up here. All right. Any other questions? I'm primarily doing weeklies. In my fund, we do a lot of monthlies, but for loser retail stocks, would you consider doing cash secured puts? It depends on the retailer. In like, you know, Ulta Cosmetics, a name that I think is really good, yeah. In a name like Lululemon, no, because I think Lululemon's garbage. All right, guys. All right, so like I said, $7, that's like a cup of coffee at Starbucks. I mean, seriously, that's a latte at Starbucks. Give it a try. I think you're going to make more than, and it's $50 a month. If we do our jobs right, you're going to make more than that every month. Way more. All right, guys. Hope everybody has a great day, and I will talk to you soon.